chances are that you found this video because you searched for waves. And why did you search for it? Because of this recent rally here, right? Almost 50% in the last 24 hours. What's going on? Does it make sense to jump on this? And in order to answer this, we are going to look at statistics. We're going to look at a backtest of moving averages. We're going to make the calculations here within the video. And then based on numbers, based on statistics, we can then decide what should we do in a situation like this. Now, first things first, where are we currently over here? We are looking at a trading volume increase of more than 600%. A lot of attention here on waves. The price is going up, as said, almost 50%. And with that increase, waves is now at market rank 32. So it's the 32nd largest cryptocurrency. It already has a market cap of more than 5 billion. Now, before we go into the simulation of buying and selling, before we go into the data, let's first look at some very interesting charts. So this is waves, the long-term waves chart, starting in June 2016, all the way to today on a logarithmic scale. So this is the same chart on a linear scale, right, where we just have fixed dollar amounts that we increase here with every horizontal line. With a logarithmic scale, we're looking at the same factor for each of those lines. Now, there are two things to note here about this chart. The first is the volatility here is impressive, right? When you don't time this correctly, then you can easily find yourself in a drop of more than 90%. So that's a 90% drop over here. Then this was a 97% drop. And then just recently, since May of last year, we saw a temporary drop of 78%. So there's a case to be made here to try to time the market and to not just blindly buy and hold. This becomes even more clear when we look at Waves price versus Ethereum. So how is the cryptocurrency performing relative to what can be regarded as a relatively safe investment? And if we are positive on this, we would say there is a long-term sideways trading range. If we are rather bearish, we could potentially interpret this as a slight bearish trend, depending on what story you want to believe here. And so this already gives us a very first risk to reward, right? You have to work with stop losses over here. You have to manage your risk in case you buy into this, because if you simply just buy now and you forget about it for the next days and weeks, the potential downside is massive, right? It could potentially drop 75%. Not saying that this has to happen, but we simply want to look at risk versus reward. Now, the reward is variable depending on where you see the resistance, right? Is it 23%? Is it 75%? Or is it almost 200%? That's what you're looking at. This is how one could navigate the market. What I like to do for navigating the market is I like to use technical indicators. And one of those indicators is the moving average, either exponential or simple. So when we add such a moving average, we can barely see it now on this chart. Let's make this a bit more visible. So we add a moving average. We could potentially time the market, right? So let's increase the duration of that moving average over here slightly. Let's take the 30-day simple moving average. And then we could potentially protect ourselves from some of that bearish momentum, right? We could be outside of the market when the price is below that moving average, right? So we wouldn't be in the market during such a move here, but we want to be in the market when the price is above the moving average. So we do this kind of a gain, we do this kind of a gain. And so we are more active with our approach here. We go in and out depending on where the price currently relatively stands to the moving average. Now the question is, when we follow such an approach, what moving average duration should we take? A lot of people take something pretty arbitrary, pretty random, right? They might say, okay, let's take the 50-day simple moving average, call it a day. This seems to somewhat work, and that's all the effort people put in. I personally prefer to do backtests. I prefer to do simulations of buying and selling. And this is now where this Excel calculator comes into play. You can download this calculator, by the way, here in the premium membership. But here for the video, I will run the backtest and show you the results of what's the best moving average here. So I've inserted the historical data. So that goes all the way back to June of 2016, all the way to today. And so let's run the Excel macro and iterate over the simple and exponential moving average here. So this flickers a little bit, but that's okay. The program does its magic. And so with this, we can now see the best duration for a simple moving average is the 17-day. The best duration for an exponential moving average is the 18-day. On chart format, this is what that looks like. So on the x-axis, we've got the duration of the moving average, and on the y-axis we've got the annualized performance. For comparison, we've also got the annualized buy and hold performance. So how does this look like in practice? So this is a chart on a linear scale. In green we've got the backtest result, in white we've got buying and holding. Let's look at this at a logarithmic scale though. So this way we can find out why the strategy is actually outperforming. So on the one hand, when we've got positive momentum, we pretty much follow the price movement, but when we've got a negative momentum, we are sometimes outside of the market, right? Note how this portfolio line here is going completely flat. Then once we turn bullish again, we follow the price movements. So this is then where the outperformance ends up being. It doesn't look massive on a logarithmic scale, but note each horizontal line here is a 10x from one another. So on a linear scale, this is quite a bit of a difference. Now in this simulation, I'm assuming a trading fee of 0.1%. So that's the Binance trading fee. Waves is most actively traded on Binance. I've assumed an initial capital of 10,000 US, and the trading only included betting on rising prices, as in we want to buy the token when the price is above, we want to sell when the price is below. It does not include betting on falling prices when the price is below. When we actually do this, we even perform more. So let's do that. Let's change this variable over here. So we bet both on rising and on falling prices, depending on where the price currently is relative to the moving average. And let's again iterate over the simple and exponential moving averages. So this is our final performance. The best moving averages don't change, but the return per annum does. So this is a very impressive outperformance, right? On this logarithmic scale, pretty consistent also. And this is then the difference on a linear scale. Here again, the outperformance based on the duration of the moving average annualized. This pattern that we see the simple moving average outperforming the exponential moving average is quite common. I've run quite a few backtests now, and rarely do I see the case where the exponential moving average actually outperforms the simple moving average. Now let's look at the 7-day simple moving average in practice here in TradingView on an interactive chart. So this is what historically works the best, right? But note, sometimes we might have bad signals when we are going sideways, for example. So the idea of the strategy is to simply just buy or sell once per day, as in midnight UTC. We only look at the price once a day. We don't care about the crossings within the day. And so what ends up happening is when we are very close to the moving average, that we might be buying over here, right? On the 9th of January, we are barely above this. Just then in order to sell 2 days afterwards for, say, a 10% drop or so. Let's measure this a bit clearer. Yeah, pretty much a 10% drop. And so this can happen several times, right? We would have bought over here just in order to then sell again a few days later for an almost 7% loss. So hovering around the moving average isn't that great. So maybe we can work with some kind of a buffer, as in we need to at least cross that moving average by a certain percentage threshold. And only when we cross above are we going to buy, or only when we cross below the lower buffer are we going to sell, simply to avoid these short-term bad trades. And so that's the second part of the backtest. We can determine what's the best buffer when trading according to the 17-day simple moving average, or alternatively the 18-day exponential moving average. So let's iterate over that buffer and let the calculator do its magic. So it flickers a little bit, but that's okay. It's going up and down within the sheet. And so after a few seconds, we've got the result. Let's plot this on a chart again. This is what we get. So we could potentially, here on the x-axis, we've got the buffer. We could potentially take a buffer of like around 7% or so, and we would outperform having no buffer at all, right? No buffer at all brings us 363% per annum. Using that buffer gives us 391%. But if you're asking me, I think this tends to already be over optimization. So a lot of these buffer values actually underperform just straight up buying and selling directly according to the moving average. So even though this approach can work for some cryptocurrencies, Here for waves, it does not. Thus, the data suggests if you're considering to actively trade this, which does make sense, then forget about a buffer and simply use the 17-day simple moving average. Where is that moving average right now after this rally? It's at $33, right? So this is steeply increasing, right? We could marginally just try to draw the next values. Of course, we can't really know exactly how this moving average is going to behave because we don't know the future prices, but it might go something like this in case the rally continues, right? So if you wanted to jump on this, which is risky, right? If you wanted to jump on this, you might have to work with a potential loss of at least 20% or so. Because once we turn around here, at least history says it makes sense to sell again. Now here's why I say this could be risky. The issue is always trading volume. Look at this historically. Look here, for example, at the 4th of May of last year, right? The trading volume here was very, very high. And at the same time, the price was very, very high. So to a certain degree, trading volume is a measure for attention, right? How much attention is currently on the token. When there is a lot of attention, there are a lot of buyers. When the attention shifts to a new altcoin, trading volume goes down. And those short-term excited buyers, they might also sell off. And so at least in the short term, we can very often see when trading volume is that high that then the price might at least for a few days decline again. Now that doesn't have to always happen, right? Nothing in crypto is sure. It's always just a work with probabilities. And so here on the 9th and 10th of March of this year, we didn't see too much of a drop, a relatively modest drop. Now we are again at an all-time high with trading volume. Waves never had that much attention, and so the price was never as high. So this is basically what you're getting yourself into if you decide to trade this. Statistics historically are on your side, right? Historically, we are above the most significant moving average. That being said, during such times, a reversal can happen. So manage your risk and at least start to sell once we go below, say, $35 or so, right? When we close a day below that. That's how we can manage risk here. I am rather risk averse. And I personally find graphs like this rather scary. But that doesn't mean that this is the right decision for everyone, right? If you manage your risk, if you get out quickly once momentum turns around, then this can be a short-term opportunity. A simple message here is don't just buy this now and not look at the price action for the next weeks. Because if you don't react quickly, a loss versus Ethereum of 70% is very much possible. It happened several times in the past. It wouldn't be surprising at all if something like this happened again in the future. Now, as said, I've done a lot of these kind of analyses, right? A lot of these backtests. And it's not always easy to keep track of all of those moving averages for all of the different assets. And so for the premium members, we've also got an alerts channel here in Telegram, where a bot automatically sends a message for a variety of cryptocurrencies when they hit their statistically important moving averages. If your moving average is not yet in that alerts channel, simply ask me here in the premium chat. I will then do a dedicated backtest and add this to the channel. I do a separate backtest for the premium members basically every day. Now the Excel sheet can be downloaded here in the statistics library. There are quite a few backtests, some of them for moving averages, some of them for the relative strength index, correlation analyses, all kinds of interesting content. We've even got a dedicated course on technical analysis on technical indicators here. So if you want to learn more, the link is in the video description, thebitcoinstrategy.com. The current price is $49 US per month. You will lock in that price, so this will not increase. If you decide to pay yearly though, you do get 2 months for free. I will still continue to publish free content here on YouTube, so don't forget to subscribe. And of course, a like on this video would be very much appreciated as well. It will help the channel grow. Thanks for watching and see you next time. Bye bye.